Are we still in that sort of collusive, Wall Street or so the bigger banks are king of that kingdom period? Yeah, I mean, more so. And the average, salary on Wall Street is like $471,000 versus 60 something in the overall community, which would actually be lower if you didn't throw in the heights of Wall Street. That's a pretty wide gap. So what this whole period has done is it's allowed the banks that were strongest to continue to persevere. The ones that are closest to the Fed still are. And this is all because they persevered over the tightening of money. They were doing fine beforehand. They're actually doing better now. Because some of their competitors have either been eaten up by the larger institutions because they had depositors leave, because they're having poor loans on their balance sheet. So the bigger banks are continuing to become bigger, and nobody's actually paying attention to this because they're supposedly strong, even though 3 out of the 4 main ones just failed the stress tests recently that they actually create the questions for.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The stock market's hit another all-time high this week, and Wall Street profits for 2024 are off the charts, nearly twice as high as last year's. Meanwhile, the wealth divide in America continues to widen as average folks struggle with the post-COVID surge in cost of living and record high interest rates on their debt. What does this growing difference between the haves and the have-nots say about fairness in today's society? And how much farther can it be stretched before some financial and/or social boiling over point is reached? For perspective, we're fortunate to speak today with Nomi Prins, reformed Wall Streeter, author of the bestsellers All the President's Bankers, Collusion, How Central Bankers Rigged the World, and Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. She's also the publisher of Prinsights with Nomi Prins on Substack. Nomi, thanks so much for joining us today.
Thank you so much for having me on, Adam.
Hey, it is such a pleasure to get to interview you again. I think this is your first time on camera with me since Thoughtful Money launched. Super glad to have you here on this platform. Lots of questions for you, Nomi. If we can, maybe let's just start with the generally, intentionally broad one I like to ask at the beginning of these discussions. What's your current assessment of the global economy and financial markets?
I think the global economy in general is moving forward, and I think we have to look at financial markets and the global economy segmented across areas. So in the United States, we've seen, the prints of GDP, which are over 2%. You adjust them for inflation, though, they're flat. So from the standpoint of economic growth in the United States, anyway, there really isn't any. It's fairly anemic. It's not necessarily recessive on any one quarter, but it's definitely not sort of moving leaps and bounds. There are reasons for that, including no strategy for growth in the United States. But if we take a look in other parts of the world, for example, in the BRICS communities, in China, which yes, its growth has slowed, but it is still moving forward. In South America, in Brazil, in areas where there are research-rich, asset-rich components of economies that are driving the future economic growth of those areas, the globe is actually growing economically. From the standpoint of financial markets, obviously we have seen records in the United States. First, it was in anticipation of rate cuts, and then it was because, oh my gosh, we got a 50 basis point rate cuts, yay, what's coming next. But we've seen a number of rate cuts and future rate cut anticipations moving throughout the world as well. People's Bank of China has basically reduced and made less expensive their monetary levels for both consumers as well as for companies within China. So things like that have been going on. The UK has done a couple. Bank of England has done some cuts. The European Central Bank. So we are seeing all this cheapening money around the world. So markets are saying, look, we've managed to go through a period where it was tightening because it was fighting inflation, which is a separate issue. I do not think inflation can be controlled by central banks, certainly not asset or supply side or demand inflation. But be that as it may, now there's no barrier on that. So even if we get higher inflation, the idea of watching inflation too hawkishly has really been peeled back. So now the markets are saying, okay, whatever happens economically, whatever happens from a labor market perspective, whatever happens from an inequality perspective, we will get fed cheaper money supply by the world's central banks, and that has proven out. It took a couple years, but we're back on that, and that's why they're zooming. And I think they will continue to, albeit we will have periods of volatility. We will have exogenous events. We will have some black swans that could pop up, but overall, this experiment that we've had since the financial crisis of 2008, 2009, which is for central banks to effectively float the debt and the money and whatever growth there may be in their countries, that despite a small reflection to fight inflation, is back in play. It never really left.
Okay, so that playbook still in play. We had to take a little bit of a break from it to get inflation back under control, but now that pretty much is, according to Jerome Powell and the other central bankers heads around the world, it's back to the old playbook. Markets, sounds like you're saying, are saying, all right, it's game on. All right, like we're good, got the Fed put again, we're off to the races. As I said in the intro, markets are trading at an all-time high, and the day that you and I are recording this, seems like you expect more all-time highs in the future from here.
I do. I expect, obviously, there could be periods of volatility and stress and events that could create downsides and intermittent downsides. But overall, what we've seen is what happened with COVID and what happened post-COVID is a complete painting over of any sort of drama that a massive stress factor caused. And we're back to higher highs than we had going into that period. So yeah, I think that in spite of all of that has been thrown in tightening mode for a while, we do have the Fed put. We have a global central bank put. That doesn't mean there won't be inflation. There will be. It doesn't mean it won't go higher. Inequality will be higher. But from a market standpoint, the trend has resurrected itself and remains positive.
All right, and is it fair to say, Nomi, that the playbook coming out of the global financial crisis was, let's monetarily paper over our issues and just try to, float the economy higher by monetary intervention? And did COVID just basically teach us to, do that, but also when you need to, also just do direct fiscal stimulus? So has the playbook been even, amended more aggressively to say, when times get tough, take the monetary cannon and add the fiscal cannon to it?
Well, it's even more than that. It's the fiscal cannon has two spots that it emanates from, right? It is funded by debt. And what we have seen is, for example, our debt as a country has increased by 7 times since post-financial crisis. We are in a significant period, not just in the United States, but glaringly so in the United States, of debt. And so what has happened is the amount of debt that was created to fund some of the fiscal stimulus that was also created in the wake of COVID has far overshadowed the amount of fiscal stimulus. So even though central banks were there and put interest rates back down to zero, as they did in the wake of the financial crisis. And even though the Fed created up to $9 trillion, they basically doubled the size of their asset book. So what had gone down from a height of $4.5 trillion of an asset book down to 4.1 just before COVID popped right back up to almost 9. And now we're, hovering around 7. There is still a tremendous amount of non-fiscal stimulus that the Fed is basically provided to the banking system and the financial markets. And that's one of the reasons that we have seen the boomerang effect, this bounce back and up effect, even though rates were curtailed from March 2022 to the following July, and now they're being cut again. So again, the amount of fiscal stimulus was much less than the amount of additional debt we continue to have to take on to operate the country. And what's different now as well is that other central banks in this equation, if we look at collusion, if we look at the overall global central banks, have basically said, for example, People's Bank of China, we actually don't want your debt. So when we held more than $1.3 trillion of your debt as a portion or compared to what the Fed had on its books, now we're down to 750. Now we're basically almost cutting that in half. We're buying gold, we're doing other things, but the changing has also occurred in how central banks both support their own domestic systems, how they interrelate, and then how the world effectively works off of central bank largesse.
Okay. God, there's so many different threads I want to pull on that. I think the big one I want to get to is, what is the cost of all of this intervention? And as I said in the intro, certainly this, coming out of COVID, we've had this K-shaped recovery, which is emblematic of the increasing wealth divide that we have on here. And so we're getting a smaller percentage of haves that have kind of almost everything, and then a larger percentage of folks that are really struggling and are seeing diminished future prospects. So I want to get to that, but you've mentioned a bunch of important things we should probably talk about. One of which is, I know you've been writing a fair amount about this recently, but clearly the world is not unipolar any longer. Becoming much more, I'll say multipolar. Some people say bipolar. I'll just say multipolar.
Yeah.
How is that changing the dynamics? When you talked about, in your book Collusion, about the central banks, all colluding together, there's sort of that honor among thieves paradox, right? Where it's like, sure, they're all willing to band together when it's all in all of their self-interests, but at times they may bolt from the herd and stab some of their so-called allies in the back, to advance their own individual interests here. I guess true. Are we moving to a more multipolar geopolitical world? What are the implications of that? And I know we'll talk more about this later, but I also know from your work that real assets are playing maybe a heightened role going forward in that geopolitical Game of Thrones than they did before.
Yeah, it's what's happened is, in the financial crisis did catalyze the beginning of it, and then COVID and other events that have happened around the world, is that there's a couple of different policies central banks have had. There's monetary policy, they're setting rates, and the collusion that happened in the wake of the financial system. You're right, we know this. There was a major, financial market disaster. Nobody wanted their economies to fall apart. The flow of funds throughout the world to basically keep the financial global system alive, to keep banks alive, necessitated trading in dollars, flowing dollars, having dollar swap lines, having zero interest rates, and printing all that money in different ways around the world. That was required, you're right, sort of honor among thieves, or basically let's all save kind of ourselves, our jobs, our sort of insulated sort of power bases, all at the same time, right? And that happened. And now what we're seeing is a different kind of collusion. We still have a lowering interest rate environment, and we still have high assets on books of central banks. But what we're also seeing is a bifurcation of the nature of those reserve assets, as we see more of a, I think bipolar, but as we see different poles in the world. It's not just all about the G7. The BRICS has had a tremendous recently growth in terms of initiation of more members joining, and also trading amongst themselves. So if we move away from monetary policy and reserves, the United States dollar is still the main global reserve currency, but it's lost a significant portion of its reserve currency. It used to be over 70%. Now it's just under 60%. I mean, we're looking at a declining reserve currency balance of dollars. Now that can rise if we have a major financial crisis, again, for the same reasons it did in the wake of the financial crisis. But even with that having happened, it's going down. It's still major, but it's declining. But what is increasing, it's still a small part of what's happening in the world, but what's increasing is trade amongst BRICS countries and amongst sort of different poles outside of the G7. And also some of the G7 countries that are like Japan, that are looking for, sort of multi-partners. There's a situation where a lot of European countries are saying, we can trade with the US in dollars, and we can trade with the Chinese in their currency, in the renminbi. We can do both. Right. And so what's happening is, from a just action of payments, of trade, of all that, we are seeing that 85% of the trade amongst the non-G7 countries, amongst primarily the BRICS countries, is happening in their own currencies. And so this de-dollarization trend It's not displacing the dollar yet. It's not going to do it tomorrow or in 10 or 20 years, but it has taken more aggressive permutations around the world. One of them is trade, one of them is alliances. And then the third, and you sort of mentioned it, is something I look at quite a lot, is where real assets come into play. And that includes resource assets, energy assets, and the national security that is associated in the world with having and processing assets in your own national community.
Yeah. All right. So maybe we'll come back to that in a little bit here, but I'm assuming that that is going to place a bid under a lot of these global commodities, at least the ones that are, have sort of national security interests. Yeah.
Yeah,
Okay. You're nodding
it's
as
a
I'm
bid,
saying
and,
this.
it's gonna, I'll let you say, it's gonna place a bid, and it's also gonna change. So now that we have a sort of multi-polarization, as you say, or in that respect, yes, countries can go with whatever polar, bipolar one is. I kind of look at it, but either way, when trade is happening in important energy or national security type commodities, that by default then changes the nature of how national governments view their national security, energy, and economic policies. So then it comes back the other way. And then, so if you're the United States and you've outsourced a lot of processing of certain materials that you need in order to make everything from medical to defense technology, and with semiconductors in between, you have a problem, and you need to address this then from a political standpoint, from a policy standpoint. So it all comes back to not only how is the world realigning from the standpoint of currency and financial flow, and what the central banks can do to make that easier from a monetary policy perspective, but now it's going into a sort of war for assets under the ground that can also impact future strength of these new poles.
Yeah, got it. And I mean, I believe this is probably already happening to a large extent, but we're seeing the redrawing of global supply chains. And part of that was, hey, we just had these long extended supply chains, and bringing back some domestic manufacturing just helps us with resilience. And then this term friendshoring has come into play, which is, let's bring it to countries that are either closer to us. So in the case of the US, Mexico, or friendly with us in the case of the US, Mexico, right?
Right.
Do you expect to see a lot more friendshoring where people are bringing, or countries are bringing their supply chains into the countries that they know are on their team, in this multipolar world?
Yeah, absolutely. And one of the things I spend a lot of time doing is working with policymakers in different countries and on both sides of the political spectrum. So just sort of looking at the economics of all of this. And what I've seen in the US anyway, and a lot of legislation that has come out on a bipartisan basis, net of all the political noise that happens, is that the language, and I've been involved in this language, has expanded. Whether it's uranium fuel security acts or critical mineral security acts and so forth, it's expanded to include allies. So what used to be sort of domestic supply has become domestic and allied supply, or domestic processing has become domestic and allied processing. So of these commodities. And so this is happening in real time, and it's happening around the world, that kind of friendshoring, that kind of, we as the US, as Canada, as Italy, as Germany, we can't necessarily source everything that we need to have our economy work as it works by ourselves. So where do we go? And who do we trust? And how much does it cost? Both monetarily, financially, but also from a national security perspective. And we've seen a lot of this over the years in oil, really. I mean, that's been the oil, natural gas has been the way that we have looked at how geopolitics and national security sort of meet up. But now it's more, it's other kinds of assets. It's uranium for nuclear security and power. It is rare earths for permanent magnets, which go into defense systems and into our computers. It's a lot of different things that will start to, yes, be friended in terms of the alliances that produce, create, store, move these kinds of assets. And I see that trend as really having longer term legs. I don't think it goes back. I don't think that the US all of a sudden says, you know what, China's processing 90% of like the materials that go into our defense systems, that's okay.
Right. They did the
Yeah.
lowest cost bidder. We'll just send it all back to them. Yeah, that's probably not going to happen at this point.
Right. I don't think the trend's gonna, there's, look, there are corporations involved on all sides of this, right? That have footprints in every bipolarity and are looking for places where they can produce whatever it is they produce cheaply. And that is from data, to processing magnets. That is also what's happening now. And the other component of that is where can they energize it most cheaply? Where can they run what they do? In the cheapest way possible. So you get countries like Brazil, which is kind of it's in the BRICS. It's the B in BRICS, but it's also kind of a friend of the United States. It's also a friend of China. It trades with both. It has it's energy positive. It has energy to spare. So you've got companies like Dell going out there and just sort of building up data centers because that's a thing.
Yeah, cheap and plentiful energy there. Yeah.
Exactly. So there's a lot of change that is happening in the world today that's going to have really long legs that connects from commodities to national security to these bipolar uh, aspects of power, and also to where legislation comes into that across the world.
Okay. Two last questions on this, and then we'll get into the red meat of wealth inequality. How inflationary do you see this trend being? Sounds like just as a currency, trade currency, real assets are going to become more in demand going forward. You talked about a floor being, placed on there or a bid under them. As well as all this friendshoring and any part of it that gets domestically reshored, at least in the West, is going to get reshored at higher rates than production rates for sure as they were getting, in, let's say, Southeast Asia.
Right.
So does this mean that inflation may be secularly higher going forward? Will that have implications for interest rates? I mean, are you sort of thinking along those degrees of order coming out of this?
Yeah, so I personally don't think that raising rates really was what impacted the inflation spikes that we saw in the wake of COVID when production and mining and supply chains were basically shut and had to be restarted. So there was a significant amount, both of the growth spike that we saw right after that, as well as the inflation spike, that had nothing to do with the Fed. Where the Fed does have an impact is on anything that requires financing. So for example, raising rates is supposed to reduce the cost of housing and therefore and also the cost of rent, which it didn't do. So I do think that inflationary pressures will continue to persist. And in terms of real assets, it depends how much they are in need and for how long and in what quantity. So if we look at something like copper, for example, that kind of went down on the this idea that China wasn't going to be as economically strong, and then they popped out and so forth. There we see a situation where that's creeping up, and it's also used in so much electrification and so much energy transformation. That's a long-term trend. So even if you got economic slowdowns along the way, the trend is up. And so the inflationary components related to in-demand assets, I think are baked in. The geopolitical components that come into oil or come into natural gas, when there are issues in the Middle East, when there's additional fighting or so an expansion from Russia into Ukraine or wherever else that might happen in the world, that can continue to produce inflationary pressure. So we have two things going on. So yes, I think inflationary pressures in today's world, given the repositioning of the supply chain and the need and demand for things that aren't necessarily all produced and available, will move inflation up on those related items. From the standpoint of monetary policy, does this mean the Fed's going to come in and increase rates again? It could mean the Fed could pause a bit and wait a bit, but the Fed still has to deal with, as other central banks do, the actual economic growth and also the actual labor market. Talk about inequality and so forth. We have seen that the labor market was getting weaker as Powell was focused on inflation instead, and sort of the 50 basis points in one go could be seen as trying to catch up with that. And so I think you can have both things happening. You can have the central banks keeping rates the same or cutting rates or even occasionally bringing them up a little bit and still have inflation persisting in general all around us. More high at a higher level than it was sort of coming out of the financial crisis and before a lot of this repositioning in terms of real assets, geopolitics, and so forth, and trade and other currencies, which are based on real assets, also has become more of a thing.
Okay, so before we're done here, Nomi, I'll ask, kind of given all that outlook, what do you think are intelligent either investment strategies or particular asset classes that you think might fare well in that type of future that you see coming? Before we do that, though, let's roll up our sleeves and get into inequality here. So let me ask you this. So you've written, all the books that I mentioned at the beginning of this interview. This is a topic that you're really one of the foremost experts on. So with your expertise into the inner workings of Wall Street and the central banks, where are we right now on the collusion and distortion meters, right? Are things more rigged than ever, or is the pendulum swung back to a slightly more free and fair system? What are you seeing right now in the landscape?
Well, we are seeing once again Jamie Dimon's name being batted about for a potential Treasury Secretary spot in a new administration. So some things don't change at all.
Mhm.
We do see, as you mentioned, that Wall Street profits, particularly at the larger banks, are really back to almost where they were at before COVID, when rates were lower and before there was as much padding as there has become on books of the Fed. We do know that commercial real estate and other sorts of regional banking issues are still growing in the general economy, that office leases aren't getting taken up, that multifamilies are struggling to potentially pay their rents, and so assets aren't worth what they were when loans were taken out, and rates are higher than they were. And we know that household debt is at record highs, and that includes higher cost of credit cards, higher cost of mortgages in the last few decades, and also higher costs of all the other necessities. So if we look at all of that stuff together, and you look at the fact that Wall Street's back where it was, and the average salary on Wall Street is like $471,000 versus 60 something in the overall community, which would actually be lower if you didn't throw in the heights of Wall Street. That's a pretty wide gap just there. And if you throw in CEO pay and all of that, obviously the gap becomes wider. So what this whole period has done is it's allowed the banks that were strongest to continue to persevere. The ones that are closest to the Fed still are. The ones that are working internationally with international partners or with their or being out in the world, like HSBC, kind of around the world, are doing fine if you look at their trend lines. And this is all because they persevered over the tightening of money. They were doing fine beforehand. They're actually doing better now. Because some of their competitors have either been eaten up by the larger institutions because they had depositors leave, because they're having poor loans on their balance sheet. So the bigger banks are continuing to become bigger, and nobody's actually paying attention to this because they're supposedly strong, even though 3 out of the 4 main ones just failed the stress tests recently that they actually create the questions for, and so forth. So are we still in that sort of collusive, Wall Street or so the bigger banks are king of that kingdom period? Yeah, I mean, more so. But we also have other actors. We also have very extensive asset management companies that have basically popped up, and that from private equity through retirement or ETF or other types of management of funds and the reallocation of assets have also taken on the asset size or surpassed in some cases some of the asset sizes of larger these bigger banks. And so that gives them power at the corporate level. That gives them more power if they're a larger percentage of buying a particular company, to have stake in what that company does and what that company policy is like. So it takes it a step away from the Fed a little, but some of this cheap money and the sort of seeking of financial assets has allowed these power players to also sort of stake their own claims as well in this whole world.
Okay, so it sounds like the bankers at the trough, have about as much pork as they've always had. There are a couple of other new pigs at the trough as well that are getting fat, and at the same time, the bottom. I'm pulling a random number here, more or less, but the bottom 80% are struggling and have. I would say that the trajectory of their prospects looks downwards from here, not upwards from here. They kind of got all the cost of living pain of the COVID policies and very few of the financial asset benefits. And then they don't have the advantages that these power players have here.
That's right.
You're nodding as I'm saying all this. I'm glad. I was going to actually read this these stats which you had published, which you just referenced earlier. Of the average Wall Street salary last year was 471,000. That compares to the average U.S. salary overall, which is still influenced. It's actually, this average is pulled up from those Wall Street salaries, as you said. That was 65,000.
Right.
So obviously, pretty big delta. I mean, we're getting into the territory of almost 1/10 of what the
Yeah.
fat cats are enjoying, right? So
And
look,
that's just the bottom of them, right? That's just, when I started on Wall Street, I looked this up, that differential was way smaller. I mean, I started a long time ago, but I was making $25,000 a year when I first started Chase, long time ago. And the average salary was just a few $1,000s below that at the time. So we're talking about, just magnitudes of changes throughout kind of the payment scale, from entry to CEO, which is obviously drags the whole thing
the whole
up.
thing up even further, right? Exactly. In other words, this nearing
This is
1/10
just average. These are average numbers, right? So
yeah. Yeah. So yeah, if we these could potentially, for many reasons, even be, the divide could even be worse here, right? So where I'm going with this is okay. So look, we had a lot of, I think, well-deserved ire at the banking class coming out of the global financial crisis. And then, of course, to add insult to injury, the bankers still pay themselves record bonuses in 2009, stuff like that. But here we are. That's ancient history. But now, basically, they're back to doing great, as are some of these new players you've talked about, where the vast majority of the populace is really feeling left behind. Their prospects are diminished. I think maybe a growing realization that, okay, this really isn't fair here. We're seeing the spoils concentrate into a very small percent of wallets and people that are doing, phenomenally well. The fact that we have so many billionaires now, and it's even speculated that we're going to have a trillionaire, not very soon, right? Where the vast majority of folks, can't come up with $500, in an emergency, right? So where I'm going with this is, how long? Well, first off, what does this say about society, that we're at this point here? I mean, is it as bad and as much of a warning sign as many think, or is it not that bad? And then secondly, if it is something that's somewhat pernicious, is there are we on a trajectory to some sort of boiling over point? I said in the intro, either a financial one or a social one, but at some point where a critical mass of people, probably taken from what was the middle class and is now getting hollowed out, just says, forget it, this just isn't working for me, and I got to take some drastic actions, ballot box, whatever, but some sort of real social revolt to this, what do you want to call it, the aristocratization of America?
Yeah, or sort of the feudalistic nature of all of that, which is that the debt overhang on the average American obviously has continued to increase. We're talking about like record levels of household debt and consumer debt and so forth, and it is more expensive. So not only are you using more debt to pay for basic needs, but it's costing you more to do that, and it can be done as long as there's enough credit that's available, and then you're sort of beholden, not just to whatever money you may be making, but to the credit card company, to the bank, to where it is you're getting that loan from, or that
Right,
card.
you're a slave to your creditor basically at that point. But yes.
You basically are, and there's a point at which that becomes untenable, and then and we've seen this. We're seeing personal bankruptcies rise. We're seeing small corporate bankruptcies rise, and so forth, because there's a tension from rates having gone up to where things are right now, and to what people need to pay for in order to live their lives or run their businesses, particularly smaller businesses, and we're seeing more of that stretch. When I wrote Permanent Distortion, after 2019 was the year of like the most civil unrest on the planet until COVID happened, right? And a lot of that was because of growing economic, yes, political and yes, religious, but also very, very much growing economic tensions throughout the world. And then of course we have COVID. It all sort of stops for a minute because no one's like out, but then it grows in all these different ways. And now, you have had inflation. Things do cost more. There are more, there is so much more tension around the world that has popped up, and that in itself drags down populations from the standpoint of living, as well as financing their lives. So, whether in the United States, we have people out in the streets about their economic conditions, I don't necessarily think that will be the topic. It's more like economic conditions create the frustrations that create people feeling that they don't have options, and that creates unrest. And it does create, I mentioned the ballot box. I mean, I think there's a good chance we see that in these elections. There is always a sense when the economy is strangling, even if it looks good, even if the market looks good, but you're not really participating in all of that, where you just vote for whoever's not in office. And we're seeing a lot of that happen before COVID. There's a lot of let's vote for who's not in office in the few years that preceded that period. And then there was a sort of reshift because of that event. But now we're seeing that more again, whether it's left voting for right, right voting for left. It's just voting out whoever is not helping me. And that is something that we have been seeing now around the world again. And so I think that's where the first line of any sort of defense is. It's in voting out whoever is connected to the sort of economic oppression that I am feeling.
Okay, so if that is a rising tide politically around the world, to mix my metaphors here, what inning would you say we're in that tide? We're still early on, or are we near the end or in the middle?
Well, I mean, it depends. Like, there are points in this world where it has already boiled over. I mean, if we look at Europe or the US, or sort of tamer environments, you're talking about a 3 kind of 4 inning, because it can get a lot worse, unfortunately, before there's we can still have a turn in elections, but I mean, before there's like more of a physical manifestation of unrest that relates to the economy, not to social issues, not to other issues, but to that connection to I can't afford it. Because
so maybe Argentina is like a 7 then, like
exactly.
They got to their breaking point and they finally brought in a guy with a chainsaw, like you've got the mandate, just
exactly. So it really depends on where we're looking. And that's going to continue. And again, we saw that into the period before COVID. We're seeing that now grow after. And that's why these things take years, right? I mean, so this is what we're seeing now. And then of course you have actual wars that are going on, whether it's in the Middle East or in Ukraine or so forth, where it is about economics, but in a different sort of way, and about so many other things. I'm not going to simplify that at all with you. So many complex things, but there is still an undertone in it, not necessarily from a leadership perspective, but for people on the ground of not having power economically.
Okay, so and I totally agree with your point there, which is when people feel economically disadvantaged, that's like the fertile soil where all sorts of frustrations can sprout. All of a sudden, class issues, race issues, just any other sort of issue gets you're already at a point of anger and breaking that it's easy to break on any number of these other things.
That's right.
So if you feel, and don't let me put words in your mouth, but if you feel that like many countries in the world, and we'll say the West too, because most of our viewers are Western viewers, they're sort of on a trajectory right now towards an Argentina-like breaking point, where a greater and greater percentage of the populace is getting to that breaking point of like, look, I don't know what the answer is, but I know it's not what we've been doing, and therefore give me anything else, right? Let's say that America watches this video and says, you know what, this Nomi, she's really got her finger on this thing. So let's make her the economic czar. And we got to do whatever Nomi tells us to do. Are there any reforms that would be kind of at the top of your priority list that you would suggest enacting here to try to reverse this trajectory?
Well, I think one thing is a big reversal of how we've replenished the financial community or the people who have more access to money with people who have less, and just created this inequality to begin with. And that's pretty big to put back. That's keeping banks and also the power that asset management has over communities, over corporations, just at a smaller percentage rate, or even having them abide by current regulations, that they are kind of all on the outside of the larger institutions. So I mean, I think that's one, that's at the top. I think at the bottom level, the fact that there is such a debt, a deluge of sort of debt, hangover, that the country has, certainly, but that individuals are having to deal with. I think that's a problem. And I think I would have more stuff built in the United States and processed in the United States and manufactured in the United States. And I say this, throughout the world, because if you have control, at least over the assets of your own economy, then you have more control over the prices of those assets. And not in every case, not of housing stock, because again, you got private equity, you got financial, you have all these other actors that are bidding for the same commodities, in those cases. But if we do have the ability to have more of the supply chain, the manufacturing chain, the processing chain, the education chain of workers up that path, I think that's a huge thing. I'm involved, for example, in a National Infrastructure Bank coalition, across parties, and have put forth legislation to create a bank, but a bank that's only providing funds for loans for infrastructure, and re-education and retooling of employees to actually have participation in those projects and so forth, which would not add more debt or taxes to the burden of the states, which then comes down to the federal government, which then comes down to individuals. So I would want to see more innovation and growth that's more collectively positive for people, and not sort of just financed or speculated by at the top, be pervasive, not just here, but in general, really in countries. So that's something else I would like to say. I'd like to see an economic strategy that actually prioritizes building, and innovating and processing and excavating here, including all the re-education that might entail for workers and for business owners in that process, because
All
there
right.
is a lot to be done.
I think I'm gonna guess you've got the support of a lot of the folks that are watching this. And, I have a lot of people on this channel who, we will spend a lot of time talking about these big major challenges. And I do hear from people from time to time, very understandably, hey, okay, great, get the problems. What are some of the things we should be thinking about on the solution side? And I really appreciate the fact that you've been doing that, and you are personally involved in trying to move the ball forward on some of these initiatives that you think are really important. All right. I do want to get to your kind of your investing outlook here, given this whole landscape we're talking about. You mentioned one thing. This may be a little bit of a tangent, but I think you're going to be a good person to ask it of. So I have housing analysts come on this program fairly frequently, and one of the things that I've sort of tossed out there as a question is one of the things that's different about the housing market this time is we have so many new players in the single family home market, from institutions, private equity coming in and buying, again, single family. I'm not talking multifamily, I'm talking single family homes. We have foreign buyers. We have the short-term rental craze, where people bought up single family homes to put them on Airbnb. And then we've had the boomers have reached the age of downsizing, but many of them haven't, or if they have kept their old home. They haven't sold it, and they're treating it more like a stock in their portfolio, right? And they're maybe renting it out and getting an income stream off of it, right? So you have all these other players that are in the mix now, beyond just the aspiring, I want to have a roof over my head, buyer, right? So should constraints be placed on the ability of these other players to come in and compete with just regular aspiring home buyers for single family homes? And I guess maybe I'll ask this in an extreme. If we're at a moment like now, like maybe we say, okay, look, there's a metric, and when the metric's above a certain amount, we want to put some of these constraints in place. So if we're in a moment like now where housing is, the average home price is the most unaffordable it's ever been to an aspiring home buyer.
Right.
What benefit do we as a society have by like a foreign national, a rich foreign national being able to outcompete families who want to live in that house, right? Yeah, the
Right.
seller gets top dollar, right, amongst all the bidders for it. So of course the seller's happy. But
Right.
we're really sort of injuring society's goals here if our goal is to have a populace that can afford to, start building equity in a home and create a place to raise a family and all that stuff.
No, these are big questions. It's sort of like the Ford model, potentially to take a look at of the early 1900s, which was, with all the negative things Henry Ford might have done, which is that I want to pay a wage that allows my workers to buy my cars. Right.
Right.
So it was a very, and this is a bit different than that, because what we're saying is, how do you keep demand for a limited, say, supply of housing from being in the hands of those that sort of dislocate the price to such an extent that other people can't get in, and then you have people who are staying in their houses because they're waiting for that big bid, or like you say, they're renting it out, they're putting it into long-term family wealth or whatever there might be, and that's a separate decision. I think just like right now, asset managers theoretically in private equity companies, and they're basically the same. They have different units, but they have constraints on how much, even though they, as I said before, that they don't abide by them, or it doesn't get necessarily enforced, about how much of a particular company they can buy, right? They have a 5% limit. If you're BlackRock, you can't buy more than 5% of Dell or whatever it might be, or particularly a small company, because technically then you have too much of a sort of muscle over something, and that's not.
Right.
Now I've been in Congress on that a lot too, and it's there are rules that don't get sort of abided by either as those things accumulate. But the idea would be to sort of expand that into at least private equity, at least the financial and hedge fund, and in the community that has more access to larger pools of capital. And I say pools, it's both cheaper and it's pooled capital that allows you to be always the outbidder and to also
Right.
drive the price up in the process. And I think that there should be a metric, whether that is the available houses in a, because it's hard to like put metrics on. Even big ones like 5% don't seem to work on a corporation stock. So, this is not necessarily simple stuff.
Right.
Whether it's in a jurisdiction, let's say, whether it's in a county or city or some level of jurisdiction where there is too much of a the math's easy, right? There's too much of the dislocation between, say, average wages here, the average cost of a home, how many people are waiting for a home, how many people afford it. There's metrics versus the external purchasing of those homes. And you at least can create a barrier for private equity and sort of economic pooled interest from potentially having too much of an impact on those homes. And if you do that in each area throughout the United States, you're not going to like crash the housing market, but what you will do is open up the buyer pool to be more accessible to buyers who don't have the luxury of more money or more pooled or cheaper resources. From a foreign national perspective, it's similar. We just look at U.S. Steel and the Japanese steel company. That deal that basically is in the ether right now. But U.S. Steel is a steel company that's been around for a long time. It has, I wrote a piece on it on Substack. It has sort of sentimental value. Steel's important, but it's not really doing that well as a company relative to other companies. So, it has an international buyer, but because it has so much connection to the heart of American manufacturing and longevity and history, that's a deal that's like, okay, we won't do that deal. We'll do a merger within the United States. We just won't necessarily. So it can be done. I'm not saying the deal won't happen, but at the moment it's sort of on pause. But these things can be done on a foreign level as well. We can create percentage barriers that are economic and just to an extent keep and preserve some of the pricing for affordability. And I think that's a better thing to try and do than just say giving blanket tax breaks or money, which is also useful, but doesn't necessarily solve that long-term problem.
Right, right. Okay, great. Well, look, I very much appreciate your thinking on this, and I think personally we're quite aligned. And look, my opinion doesn't really matter, but
Yes.
I do think that let me put it this way, I think what we have right now is not fair at the individual level to these aspiring home buyers. But I just still don't see the societal benefit to letting them get chronically outbid by these
Right.
people with much deeper pockets, and you said access to cheaper capital and that type of stuff. And so, and again, I'm not talking about a ban, like a blanket ban, but it's just, hey, when things get unaffordable above some
Percentage.
level,
Yeah.
standard deviation, 2 standard deviations above historical norms or whatever, we
Yeah.
start putting these on when prices come back
Yeah.
down, and the market loosens up a little bit, fine. Any
Yeah.
player can come back in, right? So anyways, all right, well, look, thank you for entertaining that tangent. Now in our last couple of minutes here, for the outlook you have around the world that you've summarized for us, what investment strategies and or particular asset classes do you think are good fits right now given current conditions? I'm going to guess commodities may play a role in your outlook just because you've got that strategic outlook about hard assets going forward, but don't let me put words in your mouth.
No, that is true. I mean, my portfolio, my strategies that I'm really focused on right now are not all, but many of them are in the real asset space, and that includes obviously, gold for its myriad of reasons, including the fact that it is increasingly a central bank currency, but also geopolitical currency like oil was, and something that can be used as a backstop, not necessarily as a new standard, but for a backstop for trading in bilateral or multilateral currency trading agreements, and we're seeing that more and more. Similarly with silver, which is a use commodity, we're seeing record amounts, for example, of silver imports coming from India. And I wrote a piece about that, but the idea there, and for China, it's got the use in solar technology for energy transformation, and that is happening. If we look at the trajectory of whatever you think of sort of alternative versus traditional energy, there's a significant trajectory in the BRICS countries, in the external world in terms of solar, and also revolutionizing old panels, which requires more silver, right? So there's a demand there, and silver used to be a reserve currency. So there's also the potential, as gold gets more expensive, for silver to be considered a diversifying currency. We didn't think about gold being so much of a diversifier not long ago, but now that we see that is actually an accumulated reserve component, I can see that happening with silver as well. So that just creates another just buyer set and demand for silver. Copper, not so much going to be a reserve currency, but copper very much in demand. I wrote today about I saw it was in reference to a chart about sort of where all of the mining deposits are right now in terms of copper, that they're accessible and in decent, and I would say more than about 40% of it is somewhere in South America or Central South America, and as the demand becomes more and more, which is for copper, and it's a long-term demand, I can see actually investing not just in copper but in South America. So so we're moving from commodities to regions that have a replenished amount of required real assets. And I'll put on top of that, for example, Brazil, which as a nation, I spend a lot of time there, but also is as something that is really jumping up in the BRICS and also the G20 international community, because of its net positive energy. So for example, if I look at just from a standpoint of energy efficiency, there, what it means by being net positive is they have a lot of energy from solar, wind, hydropower, and so forth. Data centers are moving there. Corporations are moving there. They're looking to process there, not just extract, which used to be how it went. So there's also a switching over of a major, financial technology and other types of AI technology, global companies coming in there, and those are worth a look at, as well as the country. And then uranium, of course, I've been hugely bullish on uranium and nuclear power for lots of different reasons, and as well as the technology of it, as well as the processing and and finding of uranium. And as we've seen a number of major bipartisan acts happen and get passed in the last year and a half that really create nuclear fuel security and other types of advanced technology in nuclear and so forth, and safety mechanisms and waste management mechanisms that are all part of those bills, I see domestic and allied uranium companies doing quite well, as they have been, and also nuclear power itself, and also utilities that sort of ride off of the electrification of everything throughout the world.
Okay, I just want to note too, on the day that we're talking here, Google just announced that it entered into an agreement to buy nuclear power from a small modular reactor company, which of course we don't have any in the States yet, but what's gonna help advance that deployment quickly is if there's actually people willing to write checks today
Yeah.
to help make sure that actually happens quickly.
And that was a trend that the government kind of, for the US anyway, has started, because it's looking at small modular reactors around the world, of which China, for example, is building a lot more than we are, and so forth, that can be in production much more quickly. And that was a check that was written through the government sort of recently first into developing the technology, and helping the companies that are developing technology for nuclear modular and small modular, micro modular reactors. And what Google is doing is what kind of a different version of Microsoft did, which is, we're going to restart 3 Mile Island with, utility company Constellation. And Google's like, yeah, well, we're going to like figure out a way to get it to source, which is small modular reactors. So it's all part of this triangle of basically AI technology or nuclear power and political might.
Right. Yeah. And it sounds like you're saying, hey, folks, this is a train
It's
that is
not stop.
not stopping. Yeah.
No.
Okay. Well, fantastic. Thank you so much for being so specific with the assets that you're looking at here. It's exactly what viewers like to see here. So, Nomi, as always, such a joy to talk with you. For folks that have really enjoyed this discussion and would like to follow you and your work between now and your next appearance on this channel, where should they go?
Really into my prinsights.substack.com. I'm talking about all of these trends around, as I go to find them around the world, and also have that practical, actionable investment strategies on an individual commodity and sort of equity stock level. So it's all there.
All right, fantastic. And folks, I follow Nomi on Substack. Highly recommend you do as well. And in addition to going and signing up for her Substack, if you'd like to thank Nomi for coming on and encourage her to come back on this program as soon as she's got something else in her macro view that she thinks is really notable to share with the world, please let her know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. I got one last question for you, Nomi. Let me just give a quick 30 seconds of housekeeping first. One, folks, if Nomi has inspired you to consider potentially making some allocation changes to your portfolio, if you'd like some help with that, one, I recommend that most people watching do that under the guidance of a good professional financial advisor who understands all the macro issues that Nomi and I talked about here. And I got to tell you, folks, once you put that requirement on, the universe actually gets relatively small out there. But if you've got a good one who's doing that for you, great, stick with them. But if not, if you'd like some help from a financial advisor that does meet that criteria, consider talking to one of the ones that's endorsed by Thoughtful Money. These are the firms that you see with me on this channel week in and week out. To set up one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service they offer to try to help as many people as possible. All right, Nomi. So I always like to give my guests the very last word here. Any parting bits of counsel for today's viewers? Most of them are just regular investors who are trying to ride the wave. They're just trying to continue to grow their wealth prudently, and they probably even more so just don't want to become collateral damage to either the predatory aspects of the colluders that we talked about, or if the markets have gotten ahead of themselves here, that if there's a correction, they hopefully don't want to be caught flat-footed by that. So what kind of parting bits of counsel might you offer to them?
Yeah, first of all, I really love the name Thoughtful Money for this very question's reason, which is that
Thank you.
you do have to, it's better to think about your money than to worry about your money. And to that extent, staying involved in getting the information and taking that information in about new trends that are developing, I think is really important for two reasons. One is it gives you another consideration in terms of your investment strategy, but also when and if we do hit road bumps, and we do, no matter what trend is happening in a market that's going to occur for events or other reasons, you have a longer term view of your investments and how to ride things out. I'm not talking about staying in a company that's going bankrupt. I'm just saying that if things are turbulent, having that longer term view because you have educated yourself on new investments or how your money works is just a better way to have a relationship, I'd say, with your money. And we spoke about a lot of the different areas already, but I do encourage anyone who is watching, who isn't invested in a certain area, yes, do your homework, but invest small, because once you do that, you watch. And when you watch, you learn, and that makes you a better investor.
Very, very well said, Nomi. Thank you. And just in parting, and unfair to ask you this, but it might be important, and just give a yes or no answer. On the list of assets that you gave us earlier, I forgot to ask you about Bitcoin, but I know you've written about it in the past. Would that be on your list as well?
I do recommend Bitcoin as an alternative asset, not necessarily as the currency it's not going to take over the world, but I also look at blockchain technology and blockchain technology companies and fintech companies that use it equally.
Okay, fantastic. All right. Nomi, can't thank you enough. Really look forward to having you back on the program again soon.
Thank you so much.
Our pleasure. Everybody else, thanks so much for watching.